Hey everyone, welcome back to Corporate Decoded, the place where we decipher corporate filings so you don't have to. Today we're diving into a Form 8K from Intelligent Biosolutions Inc. And no, it's not about making your fridge smarter. But before we start, let me just say that after reading this, you might need some intelligent solutions to understand it all. This report is basically a snapshot in time for investors. So think of it like a corporate breaking news alert, telling us about important events that could affect the company. The big news here is that on February 20th of this year, Intelligent Biosolutions entered into an agreement with a company called Ladenburg Thalmann and Co., the representative for the underwriters. Essentially, it's an underwriting agreement that is an agreement to sell stocks. An underwriting agreement is a contract where the underwriters, they are like financial brokers, agree to help the company sell its shares to the public. Intelligent Biosolutions wanted to sell shares of its common stock, which is like selling pieces of the company to investors. The company made a public offering deciding to sell 1,304,348 shares. We will refer to them as the base shares of their stock, and this initial offer was priced at $2 per share. Basically, the underwriters bought the 1,304,348 shares to sell them to the public. The company also gave the underwriters an option. They were given the option to buy an additional 195,652 shares within 45 days. These extra shares are called the option shares. The underwriters decided to use this option and bought all those extra shares. This whole thing is referred to as the offering, and it was finalized on February 21st. Because the underwriters decided to buy all the extra shares, Intelligent Biosolutions made $3 million before taking out any fees for the underwriters or any other offering expenses. Following the offering, after the underwriters purchased their extra shares, there would be 6,778,837 shares out there available to trade. The company plans to use the money to help with working capital and general corporate purposes. Working capital basically means money for day-to-day operations. This stock offering was done using something called a shelf registration statement. It was filed with the SEC. This is the Security and Exchange Commission. It was initially filed a few years ago, then became effective. Think of it as them getting permission in advance to sell shares when they need to. After this happened, they filed a final prospectus supplement with the SEC, which provides more details about the offering. Okay, so how did the underwriters get paid? Well, they received an 8% discount on the price of the shares. In addition, the company agreed to pay the underwriters' representative a management fee. The fee was equal to 1% of all the money made from selling the shares. They also agreed to cover up to $145,000 of the representative's expenses. The company also gave the representative special warrants, almost like coupons, to buy up to 75,000 shares of the company's stock for $2.50 per share. These warrants can be used for a while, until February of 2030. Now, it's important to remember that all these details in the underwriting agreement are mainly for the people involved in the agreement itself. They are sharing the agreement to provide information on the terms and conditions of the agreement. The report also explains that this summary isn't the complete story. To get the full picture, you have to read the complete underwriting agreement and the representative warrant details. The company included a legal opinion from a law firm called Arendt Fox Schiff LLP. It basically says that selling the shares was legal. Next up, item 3.02, this section talks about sales of stock that haven't been registered with the SEC. Specifically, the representative warrants haven't been registered under the Securities Act. Because of this, they were sold relying on an exemption, meaning they followed the rules to be excluded. Lastly, in item 8.01, we see that the company issued a few press releases to announce the offering. There was one to announce the launch, one to announce the pricing, and another to announce the closing. If you want to see the company's PR about the offering, go read those press releases. And that pretty much wraps up the filing. So, what does it all mean? Intelligent Biosolutions basically raised some money by selling stock. They're planning to use that money for the normal expenses of the company. This move strengthens their capital position by injecting some liquidity into their operations. Now, let's talk about the company's direction. The fact that Intelligent Buyer Solutions needed to raise money this way suggests that it is struggling. The company may be facing financial pressures or have limited access to other funding options. The company will have to make sure the new capital is put to good use. They will have to show revenue growth in the next few years. One risk to consider is that if the company fails to manage the funds effectively or if its business operations do not improve, the additional capital may not be sufficient to sustain the company in the long term. This could lead to further dilution for existing shareholders or even potential financial distress. Looking at the stock, it's really tough to give a solid price target without knowing their long-term plan. Given the current situation, the risks and opportunities are basically equal. Therefore, my recommendation would be neutral. With a slight bearish lean, keep an eye on their next earnings reports and see if they are indeed able to make the most out of this cash injection. Thanks for watching. If you found this breakdown helpful, please subscribe, like, and leave a comment below.